I'm here with Michael Craig, head of asset allocation. We're here to talk about some of the movement that is happening in the markets today. Michael, great to have you with us. I just want to start with, what are we seeing right now? Because we're seeing, at least in the morning, quite a deep sell-off in what I would call momentum stocks. It seems to have come back a bit right now, but what's happening?
Yeah, there's a bit of a bifurcation in the market. The more tech-heavy momentum names, which had done phenomenally last year and for part of this year, are really taking on the chin. It's been a couple of days now. While your more cyclical names or companies that tend to be more sensitive to economic growth have actually fared pretty well. So bigger story, at the market level, yeah, you're seeing the Nasdaq's down quite a bit, but the overall market down a bit. But underneath that, pretty violent rotation occurring last few days.
And we've talked about this rotation before. What is this rotation? What do you expect to see?
So a lot of this is based off what the bond market's telling you. Interest rate curve has really shifted upwards, meaning longer dated debt has sold off. It was a big winner going through COVID as people really fled to safety, and has been selling off quite a bit in the last 6 months. And with that curve steepening, is really telling you that the economy is healing and that we should expect much stronger growth this year. And the key thing here is that growth and the stock market are always in sync. The stock market is more of a forward discounter. And within the stock market, those companies that are more sensitive to economic growth have really done well or started to do well, are more value cyclicals. Whereas companies where, maybe they make money, maybe they don't, but they're more growthier or hope for growthier names that have suffered because that discount rate's gone higher. You're looking at long-term yields now through 2% in the US. They were below 1%, a year ago. And so that's really had an impact on growth names.
Do you expect to see more of this rotation? I mean, rotation sounds like such a gentle word. It doesn't feel terribly gentle this morning for those who have some of those stocks.
Yeah, I mean, when you think about rotation, maybe stare at the dryer for a bit. That's what's really happening. It's very aggressive, and we would think that this year, cases around the world are dropping. I think you'll start to see reopenings in the spring. There's pent up demands. Savings rates have gone quite a bit higher. People are sitting on a lot of cash, and I think you're going to see we've talked about this mini boom, which is going to probably feel more like a boom come summertime. That's good for financials, good for materials, not so good for tech. And I think that's probably the tactical position for this year. Longer term, like if you had to pin me down and say, where do you want to be for 10 years? I think technology is still probably going to be a winner. But I think, after seeing some phenomenal gains, you're seeing a bit of a retracement. This is very, very healthy, by the way. I mean, when you're up, 200% on a name and you give back 10 or 15, not the end of the world. In many ways, this is enforcing a bit of discipline. I think people started to feel like, the markets were easy. Anyone could make money. And it's days like this, you're reminded that the market can be, can kind of lull you in, but be quite brutal when it starts to shift. And that's what's happening now. I think people are caught offside and are feeling it. So that's the key for us.
Last question for you. The Fed has come out and been, I'd say, clear in that, they're in no hurry to move rates up anytime soon. And they keep re-emphasizing that message. Is that helping with, I'd say, some of the volatility we're seeing right now, because that's part of the reason we're seeing some of the excitement around momentum?
Well, it's soothing things. There's a bit of a challenge here. The Fed is ultra dovish. The Treasury Secretary Yellen has been very, very aggressive on what they're going to do fiscally. So the big difference now is that, you sometimes get policymakers always fighting the last war. After the great financial crisis, the mistake that governments made was they pulled back too quickly. In the UK, they went to austerity. In the US, they went to primary surplus quite quickly. And you had, as a result, 10 years of somewhat anemic growth. This time around, I think you're going to see the opposite, where policymakers are really going to push and spend. And so we should really be mindful of that curve steepening more. And at some point, the Fed might be tested here to come in and really try to maintain, whether it be curve control or come in and suppress longer term rates. This is not a core view, but it's not a zero probability either. I think for risks, this is some risk I think we need to pay attention to in terms of at what point does the modern market steepen too much and people get a bit worried. We're not there yet, but something I think we'll have likely want to look into come this summer.
Mike, always great to talk to you. Thanks so much.
It's my pleasure, Kim.